Yeah, the other thing I really liked what Powell did is, I don't know if you heard it, but Elizabeth Warren earlier in the week basically sent a letter to Jerome Powell saying cut rates and cut rates now, meaning this meeting that occurred and ended on January 31st, because he is solely responsible for high home prices. This was Elizabeth Warren's opinion. Jerome Powell addressed that via Q&A and basically said, sorry, our tools can't impact home prices. It's an asset. We do track owner's equivalent rent. We do track rent from apartments. That is declining, so our job is working. But we can't directly impact assets. And wow, the aftermath of Fed Day has been violent. A couple of big moves in the rate market. But is it translating to mortgages? I have no idea. And we talk about buying homes a lot. What about when you're ready to refi a home? We're going to have these conversations with the one and only Dustin from Convoy Home Loans. Dustin, how you doing, man?
Good, good. How are you?
I'm all right. So we had Fed Day. Fed Day is in the books. The Fed says they are at terminal rates. They are not in a rush to cut in March. They are not responsible for high home prices, and they are not yet ready to call soft landing. But what has happened to the rates? The 10-year note it's down pretty big the last 2 days. What's going on?
Yeah, we going into Monday compared to where rates were Monday to today, Thursday, February 1st, we've seen across the board, I'd say on average about 25 basis points or, close to a quarter point drop in rates. That 25 basis point drop is something that we saw increase, from kind of the first week of January all the way through the end of the month, just because of all the speculation on what the Feds are going to do. Not at this meeting. Everybody knew there was no cut. There was no hike. We knew that, but at least some of the comments they wanted to hear from Powell regarding, March or May now in terms of a rate cut or is inflation done, et cetera. But overall, it was, a nice little drop in rates that we'll always take.
Yeah, no, I really do think what we saw the last 2 days was kind of undoing what was done much of January. Because I think the market was like, we want it in March, but we're afraid it's June. And now it kind of sounds like it's going to be May, right? Without splitting too many hairs. So, in May is going to be here pretty soon, right? It's May 1st, I think, is the actual Fed day. So it's not like May 31st. So it's pretty early.
I mean, we're already a month through 2024. I still can't
It's February 1st. Oh my God.
Yeah.
Really? It's wild.
Can't fathom that.
It's just wild. So again, the Fed, the other thing, again, I always just want to remind people, right? The Fed did nothing, meaning they held steady. But rates are down basically a quarter point because everybody, not everybody, many people think, hey, the Fed does this, mortgage rates must do that. That's not what happens. Rates went down because the market's really a leading indicator, right?
100%. And that's something we've talked about a lot of times on this, channel with you. It's that whatever the Fed does not mean there's a direct correlation in terms of what they do with moving, cutting, or staying with where mortgage rates will go. There's always going to be more so what does the market believe based on either the minutes or what Powell's press conference will say. And, what I think, I don't know what the exact, Powell was like, which I think the market took a lot to heart to and will rally behind, that we've most likely reached our terminal rate, right? Meaning
pretty
no
clear.
more Fed rate increases. We kind of knew that, but to hear it come out of his mouth, that gives the market a lot more ammo to be like, all right, we're going in now again. We're happy mode again. And that's the biggest thing that I took away from the minutes. Yes, we're not at 2% inflation. But ultimately that's what the market wanted to hear. Something more dovish than we expected in 2023.
Yeah, the other thing I really liked what Powell did is, I don't know if you heard it, but Elizabeth Warren earlier in the week basically sent a letter to Jerome Powell saying cut rates and cut rates now, meaning this meeting that occurred and ended on January 31st, because he is solely responsible for high home prices. This was Elizabeth Warren's opinion. Jerome Powell addressed that via Q&A and basically said, sorry, our tools can't impact home prices. It's an asset. We do track owner's equivalent rent. We do track rent from apartments. That is declining, so our job is working, but we can't directly impact assets. And this is something I obviously talked about years ago, or when he made this statement that he can't affect prices, only transactions. But I thought it was pretty interesting that he hit that head on.
No, what you just said at the very end, you can't affect prices, but or transactions, right? What I think is important, and he made it clear, I think it was in yesterday if I was reading this correctly, but he's not going to fix the supply problem, right?
No,
That's
none of his tools,
like,
none of his tools do that. Not
exactly.
his thing.
That's exactly the point. And going back to what the markets were, digesting from the meeting yesterday, I read something that I thought was pretty accurate that maybe a lot of people might laugh at or agree with. But the analogy that, there's a parent teenager relationship between the feds and the market, right? The market obviously being the teenagers, right? They hear what they want to hear. They sometimes act, in ways that don't make sense. But ultimately, in that situation, I think with where we've been and kind of markets always trying to get ahead of what the feds are saying is a good one.
Yeah, I totally agree. Well, you know what? The other thing that happened this week that I thought was interesting, I think it was on Wednesday, we got purchase and refi demand. Purchase demand was down 10%. Purchase apps, to be clear, down 10%. Refi up 2%. We'll talk about purchase first, but let's really close in on refi because I think there's more and more people going that direction. Purchase demand, I'm hearing from across the country that there's a lot of people kind of writing offers. Bidding wars are coming back for kind of the lower end first-time homebuyer homes. What are you seeing with purchase applications in your business? Is it up, flat? What's going on?
So we haven't ran our numbers yet for January. We ran them at the end of 2023, which we'll do a video maybe next week on.
Sure.
But in the last 2 weeks, we met yesterday with all of the numbers for the month of January. And our increase in volume, I haven't broken apart the purchase and refis. They've been pretty equal compared to what we had in 2023. But we saw a 34% increase in not just applications, but deals in process from January of 2024 just to December of 2023.
Month on month, 34%.
Month on month, not year on year, but from the month of December. Now, don't get me wrong. It's always a big drop or big increase between December and January. You got
not 34%.
But not 34%. So it was, and as a result, we kind of went on a hiring spree, to be honest with you, because we were like, dude, we got a bottleneck. We got to fix this ASAP. So we hired 3 or 4 more support staff in the last 2 weeks because of that. And,
I want to be clear. I mean, I would call hiring a leading indicator.
Oh, yeah.
Right.
If I had to hire, I haven't hired, honestly, like processors, underwriters, support staff since the middle of 2022. And we just hired 3 more this month.
I hope people are listening. There is no question, no matter, regardless of what the doomers are saying and the nonsense they are preaching, lower rates increase demand. I mean, I can't get, again, it's not a hard problem to solve. Oh, this is so funny to me. But you know what? Let's switch to refis. So there's a lot of folks that got into hard money loans that are now looking to keep their properties, but they need values to come in. There's a lot of people still doing BRRRRs or Airbnb this or that. And I know refis are up. I mean, just look at last week. I think they were up 2%. The week before, I think they were up 8%. So going up. What is some advice you have for folks on refis? Because let's be honest, refis have not been something we've talked about for a couple of years. Because rates were going one way and that was only up. So what's going on with refi folks?
So I'll try and break it into like maybe 2 parts. Ones that are, I'll start, got a 30-year fixed rate a year or 2 years ago versus those that most of the refis we're doing are out of hard money or bridge debt. But on the refi, out of your 30-year fix, maybe you bought a property last year, maybe you bought it a year and a half or 2 years ago. The biggest advice that I'm telling a lot of our clients is, look, if you're going to refi right now, even if it's 0.5 or 0.3 maybe not 0.2, but something above 0.3 or 0.5, ask your lender or broker to give you a no closing cost option, because that is a possibility. Some people may not think that, but that is. You can get a no closing cost option, and maybe the no closing cost option is only saving you 0.3 or 0.5. Whereas if you pay, 1 or 2%, or even pay on top of that 2 or 3 points, you might save a full percent or a point and a quarter. It doesn't make sense with the market that we're heading into, because if you do the math and you do the work, or your lender or broker does the work, most points, if it's a 2-to-1 buy down. Now I'm saying it costs you, let's say, 2 points to get your rate a full percent lower.
Okay.
Most of the time, that's going to take you just under 3 years to recover. Okay. So going into the next 3 years, there's most likely, maybe more than 50, 60, whatever it might be, a chance that rates are going to be lower than they are today.
Yeah.
If we were going somewhere different and rates were going up and we were at the end of 2020, okay, sure, lock that in, be done with it. But for right now, just ask your lender or broker to give you a no closing cost option, and then just weigh out the options. No closing cost, 2K, 3K, 5K, take this long to break even, etc.
Yeah. What I would tell folks, and I've said this all the time, is if you're considering a refi today, rate and term, you got to work with a broker who's not one of these big body shop farms. You got to work with somebody who's going to, ask questions and make sure it's right for you. Obviously, Convoy Home Loans is amazing, because if they're come from my channel, they get you and or Jonathan. So I always love that. Before we go further, let's just tell people now, if they wanted to get in touch with you or Jonathan, how do they do that?
So go to convoyhomeloans.com, mention you came from ORaaT, or email privateclient@convoyhomeloans.com, because I will be honest, we've seen a few slip through the crack because they go to our website and they'll just email maybe our intake team or our info team, or call in, and they end up being with one of our loan officers, and then our loan officer tells us that, hey, Mike's show and this client wants to talk to you, and he's 3 weeks in and he's pissed at me, and I'm like, oh, great.
No, thank you for that.
Thanks for finding out now.
Yeah, after they're mad, don't do that. Yeah,
Yeah.
folks, again, if you're on this channel, you're watching this, go to convoyhomeloans.com, fill out the form, came from ORaaT. Or is it private client?
There's a drop down. There's literally a drop down that says, where did you come from?
Yeah.
ORaaT.
And then you get one of the two guys, and you want to do that. But now let's switch gears. Actually, before we do that, let's also remind people, FHA or VA, the Streamline option is still available, right?
Yeah, the FHA VA, your primary residence homes are only applicable here, but the Streamline is a no closing cost, no appraisal, no income verification refi. You're going to have what we call like a net tangible benefit test to make sure that you are saving enough. So there's systems in place that the government made nice enough so you're not getting an advantage or taken advantage of per se, because it didn't used to be there. So you'll know if you can qualify. You'll know once you speak to your broker or lender, and they'll tell you, hey, great, no brainer, we'll close this in a week or two and get you a half a point lower.
Yeah, I mean, I love that sustainability, or whatever they call it, feasibility test. It's just an extra layer of protection to make sure the consumer's not messed with. But now let's switch to refis for folks who did heavy value add, right? Maybe they took on a burr project, they got a bunch of construction capital or make ready capital, or they were doing a flip that they now want to turn into a long time hold because the luxury market took a dump or whatever it is. What do you tell folks that are maybe in hard money or private money that need to get more permanent financing? What should they be doing to help the appraiser?
Yeah, so it's no secret here that the appraiser might be, and I hate saying this, but the appraiser might be the most influential person or party in the real estate industry right now.
Okay? No question. No
question. Like, it just is what it is. And sometimes you get dealt a bad lemon. But on our side, what I'll point out some important differences between your conforming, conventional, and kind of the non-QM private side. So you go through a conventional and you have to go through the lender's AMC. You have no control. It's a blind shot. You get a bad lemon, maybe you don't, right? On our side, we are allowed to give recommendations, pre-screen, Now they have to be licensed, they have to be signed up with an AMC. But when I say pre-screen, it's an appraiser that knows the area. It's an appraiser
Right.
that lives within the 2-3 mile radius. I had a conventional buyer, for example, I want to say maybe 2 months ago, that we needed a good appraisal. He bought it construction, did all the work himself, okay? But he had an appraiser that came out from 80 miles away. And we had to
Yeah.
rebuttal it, and it was just a nightmare,
Mess.
okay?
Yes.
It actually ended up didn't working. We had to switch lenders, etc. But the point I was getting to, the people that are investors doing heavy value add, out of bridge, hard money, you most likely know an appraiser in the area, or you know somebody that can refer you to a good appraiser that we can try and pre-screen, make sure he checks out, and get that appraiser actually assigned rather than kind of rolling the dice. Now, I know some of you might be watching me like, I thought that's illegal. And it's like, there is a loophole right now. We aren't picking that appraiser. We're giving recommendations of ones that we hope that we know are licensed, that are with the AMC. Let's at least get one of these 5 or 3, whatever. Okay. The other thing that when you're doing a refi, keep in mind the appraiser that comes out is a human being. They have feelings, they have reactions, they get impressions. So when they come to your house, especially if it's vacant and you don't have tenants in there, let's make it look nice. Let's have it actually furnished. Let's have it, in terms of stage to the degree where they walk in and they are given some sort of wow factor, because that will influence, even though it's not supposed to, they're human beings. So it will influence. Because I had another one, we're doing it right now. It's like a $5 million ski in, ski out, short-term rental in Park City that we're trying to get an appraisal and it's vacant. But I had the appraiser go out and the clients had all the drywall still being patched up. They had, and I'm like, guys, you
Come
didn't tell
on.
me this. He's going to come in and be like, this doesn't look nice, because
Yeah.
of course it doesn't look nice, right? So that's one other item. The last item that I really want to make sure your listeners hear, when you're doing the refi and you're doing a DSCR loan specifically, okay, having a lease in place is great.
Oh,
It is
it's
magnificent. It
Yes.
is wonderful, because guess what? You can actually give that lease to the appraiser.
Yeah,
You can
and they have to
show
take
them,
it. Yeah.
because that's another thing. If it's vacant, you are taking a gamble. They might go in and say it's 1,300 when you got a tenant signed next week at 2,000, right? But that does trickle down to, hey, I thought even if the appraiser, quote unquote, gives me a bad number and tells me the market rent's 1,300, but I have a lease for 2,000, I thought we have to use the lower of the two, right? Well, that has been the case most of the times. But we now have, if you have 2 months of receipt of the $2,000 payment in this example, we don't care what the appraiser says. Show us that you've been collecting $2,000 a month. It's a real lease. It's signed. We got the bank deposits. We'll use $2,000 a month. So getting a property leased up to the number that works when you ran your numbers, doing the work to make sure it cash flows positive. Let's get that done before we do the refi. Let's not try and get one just because you just finished. I need to get out and it's still vacant. I'm still looking for a tenant. Get the lease first.
Yeah, again, some of this is just timing, being in a rush, knowing how it works. If you're at the point where you're trying to get as much as you can back, sometimes waiting a month or 2 is the right answer. And again, I think people need to reach out to professionals like you and Jonathan.
Yeah, in that example, depending on where the rate is, but let's say, you rushed and you got the appraiser to put 1,300 as the market rent because it's vacant, right? But you could have waited 2 months and given him 2,000. That $700 difference might result in you being able to get an extra $140,000 out.
Exactly.
Right? Like that's like
real numbers.
Aren't 140,000 for 2 months of holding costs, right? So it's things like that I wanted to make sure everybody can maybe put in their tool belt.
Well, let me take one last right turn that we did not prep for, but I'm sure we can talk about it. I don't know if you saw this, but billionaire Barry Sternlicht talking about upwards of $1.2 trillion in commercial catastrophe coming. we're also seeing a lot more signs that that debt is residing in commercial banks. New York Bank Corp just highlighted 2 loans that were significant write-offs. So what I wanted to ask you in this space is, are you seeing commercial banks pull back like they did after Silicon Valley Bank? Are you seeing any ripples yet from lenders having to pull back yet?
I mean, not enough to make a noticeable difference, but we have seen a fair amount creep back in, really starting to market their products a little bit more, really starting to be like, hey, funds are available now, give us a call.
Okay.
So it's not that the entire book or Rolodex that we had of the small regional banks that no longer work with us are all back, but I've seen probably 20 or 30% give us a call, email us saying, hey, look, we've got a certain amount of funds. We'd love to give you a little bit to play with, which I didn't think was going to happen this soon, to be honest with you, because we still have billionaire Barry, right?
Yeah, billionaire Barry, that guy.
There's so much commercial debt that is in so much of a, I mean, the problem
It's impaired. It's impaired. Yeah, it's bad.
It's so bad because we had, a lot of investors that may have bought this 4 years ago trading at, 700, 1,000 a square foot, right? Bought it there. Now their debt that they can get on it might be 300, might be
No,
400.
I don't know if you saw this, but Barry gave a real life example. He talked about a San Francisco office building that sold at $850 a square foot, had debt at $450 a square foot, so roughly 50%.
Yeah.
It now trades at $250 a square foot.
Oh my God. See, that's a real life example, and you can't, it's not hard math to figure that one out.
No.
800, 400 to 200. Like,
not good.
Those operators are in, there's a lot of bad situations that people are going to get in a lot.
Well, I mean, let's just talk about that one example. I mean, there are several losers in that story. One, the equity. I mean, think about it. A pension, an insurance company bought a Class A office building in San Francisco at, let's just use round numbers, 800 a square foot.
Did he say when that was?
When it was bought? This year, well, the last calendar year. Oh no, when it was bought, it was bought in 2018.
Yeah, makes sense.
So long term, right? So bought at 800. They took 400 million bucks and put it in for a super safe 50% LTV loan. It's now coming up for a refi or retrade or whatever at 200.
Unreal.
So the half 400 million gone. The bank's going to lose 200 gone. It's just, yeah. So not good. Not good. Extended pretend is coming. But I want to go back to 2 things you said today that shocked me. 1, you hired 3 people and you haven't done that in over 2 years. 2, the commercial or regional banks are coming back sooner than you thought. I think both of those are interesting. And yeah, and especially if you think about the mortgage business, roughly 50% of your competition left over the last 18 months. Now it appears we're building a foundation and we might come out of this. We're building out slowly, but coming out.
Build out slowly. Very important that you said that. And I'll say one last thing, because I had a client, and he might be watching this, that texted me late last night at like 11 p.m. He's on the East Coast and was like,
oh, wow.
I didn't see rates come down enough. Yeah, I was like, you're really grinding. But I told him this, like, I don't want rates to drop significantly.
No,
I don't want it to
I
drop.
don't want it either.
And he was like, wow, that's surprising. I'm like, look, it's just going to cause the problem to be extended even longer. We'll have the same exact cycle. So trust me, let's have a very slow, reduction in the rates. Nothing, roller coaster like.
Yeah, I know you can't quote rates. That's not what I'm doing, but you can talk about a loan that maybe you priced in the last couple of days. Are we seeing rates sub 6.5 for FHA or any of those folks?
So I just have so much to talk about, I guess. So one thing that, FHA, you can still buy down, right? You can still buy down to 4.8 FHA and VA. Okay.
What?
And here's
oh my God.
I might be wrong on this. So, and I'm sorry for going too long.
Go for it.
The spread that's always been watched is between the 10-year and where the average 30-year fix is, right? We all know on average, or for most of history, it's 180 basis points, right?
Correct.
Right now we're 270, 28, whatever, whoever you're
Yeah.
using, okay? What's different is that when rates were at 2.25, 2.5, 3%, you could buy down maybe half a point. You
Yeah.
could buy down maybe a quarter at 0.7.
Yeah.
Now you can buy down almost a full 1.5, 1.75%. So what are the big banks doing? They're still giving you that in a way to make it seem as if it's like a magical illusion, because even though the spread when you're at 4.8 or 5.3, now all of a sudden that spread's lower than the 180, but they're making you pay a significant amount in points. So
Yeah.
they're slowly pulling back the drapes, if you will, to let us know that their 280 spread right now that they've been getting fat off for the last 2 years, which was at 300, 310, is starting to come back, and they're doing that by, at least letting you buy down there.
Yeah, I think one of the things that is going to be big after the Fed meeting, which we kind of opened this conversation with, is the Fed made it known that they're at the terminal rate, which I have always assumed banks needed to hear before they start collapsing the spread. So we'll see if the spread comes in over the next 30 days.
Yep.
Next up, when can people, or where should people go to reach out to you and or Jonathan?
Go to convoyhomeloans.com and click the drop down and mention you came from ORaaT.
You came from ORaaT, you get one of the two guys. If not, you get somebody else, and you don't want somebody else. All right, take care. Thanks.
Thanks, bud.